Welcome to Better Returns, where you will learn how to escape the volatility of the stock market by passively investing in real estate like a pro. 90% of millionaires earned and maintain their wealth by investing in real estate. We will share real-life examples from savvy investors so you can do the same. At work, his team would give him a six-pack of root beer for Boss Day every year. Your host and my dad, Matt Hansen.
Well, welcome back to the show. I'm very fortunate to have one of my good friends, Kanul Dewan, on the call with us today. Welcome.
Happy to be here, Matt.
I love the bio he gave me. Most people give me like 2 or 3 sentences, but Kunal, he's very deep. Here's his bio. Engineer by education, entrepreneur by choice, real estate investor by passion. That is profound. Tell us a little bit more about yourself, Kunal.
I'm so glad to be here, Matt. I'm in Southern California, and I am an engineer by education because that's where I spent, 6 years of my life working through spreadsheets and software and modeling. Started my career in this country in early 2000 as an engineer, designing buildings, then moved on to designing skyscrapers and tall buildings and hospitals, and then retrofitting buildings, and then doing the value add in my engineering profession. At the same time, me and my wife started investing in real estate. This was immediately after the Great Recession. And our life kind of took a beautiful turn when we started receiving that passive income check. And I'm still doing my education, started receiving this rental check after all the mortgages and the bills are paid off, still left over. So we started scaling up over the next decade or so. At the same time, I wanted to do more of real estate. So I started a business in early 2000, the second decade of the 2012, 2013. And built that business from 0 to early 7 figures, seasonal business. So I work a few months of the year and turn the business, have a great team using those proceeds to buy more real estate to get more passive income. And hence my intro, engineer by education, entrepreneur by choice, and real estate investor by passion. I truly believe real estate is the vehicle to actually achieve what you want in your life. So I'm so glad, I'm happy to be here.
I love how the fact that your business funds your investments. That's really great business model or great financial model. That's wonderful. So how did you discover multifamily to begin with? It's kind of a niche thing. A lot of people just don't know it exists, that you can passively invest in large apartment complexes. So how did you discover it?
Yeah, and you know what? I'll be lying if I tell you that I knew it all along. No, I started like anybody else with a condo. My first real estate deal was a condo, then a townhome, then a duplex, then a triplex, then a fourplex. And it was just an organic growth. And some things are learned better when experienced versus somebody can teach you. And they might drop you golden nuggets, but until you experience it, you don't get that deep feeling, deep understanding. I think that's who I am. So, oh my God, the more, the better. So that was the organic attraction, I would say, to multifamily over the years. Also, from 2012, 2011, when I started buying those smaller residential multifamily, all the way till end of the second decade, the deals were getting harder to pencil out. So I started looking outside of California. Then I got exposed to syndications. So this is it, because I'm doing okay in my real estate investments, and I'm attracting my friends and my family and my coworkers and my people who I'm talking to, and they want to partner with me. And that was the organic stepping into the world of syndication. Now I'm raising equity with the ex-coworkers or my neighbors. So the organic pathway to attraction to multifamily, then organic attraction from investors is where I'm at today, where raising capital and buying larger apartment buildings in emerging markets across the country.
Gotcha. What was the moment? Like, I know when I actually discovered, I was renovating a house probably like 7 years ago. I was flipping a house. My wife and I did all the work on our own. And I was listening to a podcast, and that's when I first even heard about multifamily. Do you remember? Like, I remember the podcast and the host and whatever. It was that like, oh my gosh, a light bulb went off. This is so much easier. This is just running a business. Did you have a moment, aha moment when, because you've been in doing single family home and duplexes and stuff like that? Was it just one event, or did you kind of know it was about it, and then just finally decide I'm going to do it? How did that happen?
I was losing offers and deals here in Southern California.
Mhm.
So I was making offers to multifamily here
Oh, okay.
inside my buy box, which is the cash flow and whatnot. And I was losing deals because there are people putting bids with the speculation. So to me, the aha moment was slowly realized that, okay, I got to look outside because time is the biggest valuable asset. So let's look outside California to achieve those goals. Podcast has helped me a lot over the years because listening to other people, how they have done it, how they have grown, is what really built that business into the real estate investing. Say, oh, if you can scale it, put system and processes in place, which I've already done in my previous business when I built from 0 to 7 figures.
Yeah,
Oh, you can
you've
do the
done it.
same. Yes. And so podcasts really put the fuel in that fire. And then meeting people and talking to people is what really shaped and structure where we are today.
And there's a phrase out there that says, live where you want to live, but invest where it makes sense. And that's what you've done. You realize, okay, it's not practical. First off, I would love to live in California. I live in Michigan, but California's not a great place to invest. And neither is Michigan for that matter, because we have kind of a negative population growth and all that. So what states did you look at outside of California? Was there a few you landed on? What are your favorite markets to play in?
Yeah, I started with Arizona. I started looking in with Arizona. It's next door.
Yeah.
So I can go touch and come back. Started with Arizona and then moved on to New Mexico. You cannot avoid Texas.
Yes, it's
Yeah.
big.
Then Texas and in Midwest. At the same time, I started investing passively with other great operators. So I can get the results and the feedback from other markets as well. So Midwest as well.
Good.
Those are my favorite states right now. But of course, I was amazed to learn that, in California, you live in a bubble. You live in a bubble that because the real estate, this is the hub of the real estate, this is the economy that drives, of course, one of the largest state in the country, probably bigger than a few European countries. So
Yes, it is.
we kind of, especially investors, kind of full of themselves. But at the end, when I realized that, oh my God, there's so many emerging markets, there's so many parallel economies, and actually different economic cycles that happen across the country, employment growth, population growth, and so much data to support that. That really opened my eyes to look at a big picture. And that's how I selected those states and those metro and those secondary and even tertiary markets when I started looking into investments.
Okay, so that's the markets. Now, what is the criteria, the properties that you look at? Some people do heavy, light value adds. What is your criteria? What do you really like? What's your focus on?
So let me rephrase the question. If a passive investor asked me that question, right? What should I look into so let's say I have a neighbor who bumps into me walking his pet 3 times a week. Hey, I'm looking to invest. What do you think? So I tell them exactly how I look into it, which is the property must cash flow. And now it's really hard in today's market when the basis is so high when you get in. But there should be a business plan. You got to have an eye to look for that opportunity to create the cash flow. So the number one fundamental, the number one criteria that I go by is within the first year or so, it should create a cash flow.
Got it.
I truly believe that cash flow, if you have a cash flowing asset and you're not bound by a time frame that I must exit in 2, 3, 4, 5 years, you can ride any recession you want. That's number, right? Because if the property is churning cash flow month after month, quarter after quarter, who cares if the property value goes up or down?
Right.
Of course, your debt has to be stable. Number two, I truly believe cash flow is the best way to preserve the capital. The biggest risk for any passive investor is, hey, my capital should not be lost with this operator because of some aggressive risk.
Right.
Cash flow balances those risks. So that's my number one criteria.
Very good. Excellent. Is there a size of properties, value add, non-value add? What's your other criteria?
Thank you for digging in deep. Yes, of course, value add. Larger the better. We have done as low as 30 units to as high as 200 plus units. I'm not bound by big or small properties. I'm bound by the opportunities. So if there's an opportunity that creates cash flow, which can be managed in a scalable way, then that's okay. So if it's a 30 unit, and even after a heavy property management fees, and it's located in a market where there's a huge supply demand offset, it's a great place to be. So what if it's small? And then you can use the same principle on a 200 or 3 unit building as well.
Excellent. So any learnings you've had as a limited partner or general partner that you could share with people to learn from? It's like, okay, here's something happened to me that should probably put this out there so people are aware of it and how you kind of handled it.
I think we can probably talk about it for the next 6 hours.
That's not good. There should be 2 examples. Like I have one really good example, but yeah, you're right. Okay.
So I'm going to share one from both sides of the table. I'm going to share with the passive investor perspective, and also share from a GP or a general partner or a sponsor perspective. So let's start with the passive investor. As a passive investor, almost all the time, everybody gets stuck on the returns. What are my returns? How fast can you get me? Well, my response to that is, well, if you want returns fast, perhaps Vegas is a great place to be. This is real estate. This is commercial real estate. It's boring, it's slow, and it's monotonous. But then guess what? That's what makes it predictable. And the graph is slow. We don't want this because that's what the stocks does, right? The whole purpose, you talk about taking money out of the stocks because we want small, slow, consistent, compounded growth. Small, slow, consistent, compounded growth. So that from a passive investor perspective, move away from the returns and look at the offering from a risks perspective. Risk from the sponsor, risk from the market, risk from the operation, risk from the business plan. I can slice and dice in so many different ways. So look from the risk perspective. So the simplest thing, sharing an example, lessons learned. Looking at a market, looking at a property, the rent, the revenue, the number one thing in any business, right? The rent. The biggest skewing factor is comparables. So what a passive investor can do, look at the offering, look at the 3, 4, 5 comparables where the rent for a 2-bedroom is this much, 1-bedroom is this much, right? Pick up the phone and do the due diligence by calling that comparable property and see how much is the rent, how many units, how many types of units are available right now, what are the extra little fees they bill to their tenants. So mystery shopping. It will take like 15, 30 minutes the most, but it's totally worth the $100,000 they're going to put with a sponsor. Because if the revenue is where it's supposed to be, everything else will fall in place. In the world of business, we talk about sales. Sales solves majority of the problems, right? So if they can just do this one little exercise before putting the hard capital with the sponsor, they will get the answer.
That's really
switching gears from the general sponsor perspective, from the person who's the jockey. very similar logic.
Mhm.
I want to do a deal. I want to set up an offering, and I want to reach out to my investors and, give them the beautiful returns. And then, oh, you know what? How can I make it attractive to attract more investors? The focus is again on the returns. That's the back. That should not be the focus. The focus should be, how can I make this deal not work? So I've done my underwriting. It makes work. I have a business plan. It works. I have the team, the PM, and everything that works. Okay. Now, what can go wrong? I have a saying, Matt. For those who focus on returns get the risks, and those who focus on risks get the returns. You
Ooh,
see,
that's profound.
returns is nothing but a byproduct of mitigated risks.
Mhm.
So as a GP, that should be the priority. And then after that, there's something called the margin of safety. The margin of safety is the gap between what you think can go wrong and what actually happens.
Right.
This margin of safety can never be small or big enough because that's the unknown.
Mhm.
So as a sponsor, I work in this spectrum of margin of safety, the unknowns, and how do I not make this deal work after I had done the underwriting and after it has fit my playbook of and checked all the boxes. So perfect example. So now I'm going back to the example that you asked, the case study, property manager. Property manager is such an important part of your business plan, of your execution. I mean, they are the real jockey sitting on the horse. That's where the rubber meets the road.
Yes.
And it's all based on perception of capabilities, trust. Because you don't know the PM when you go into a new market buying an asset, they're going to run the show. So you ask around, you get a referral, you meet
Mhm.
them, and you get this feeling this person is capable of running the asset, right? And then you hand over the asset and then they run the show. Well, this is where the margin of safety, there are no hard numbers to do the DD on a PM.
Right.
So that's where the margin of safety comes in. So if the capabilities do not match the expectations, well, of course, you can fire the PM or perhaps sharpen your communications such that there are processes and checklists where this PM can adopt and give you the results that you're looking for, be in the form of reporting, be in the form of communication with the general contractor or the tenant or the marketing, whatever that is.
Wow. So dropping some good knowledge. So to recap, you can't, this is a phrase we used to use in the corporate world. You can't save yourself to profitability. You need to make more money. And that's where you're talking about the rents. You need to be able to bump up those rents, and everything is Googleable. People need to do their due diligence. But the whole thing is secret shopper takes it to the next level, because when I was in acquisitions, I used to do secret shopping. I would go look at the comps apartments that we're going to put an offer on. We look at the ones across the street or whatever, and I pretend like, I'm going to rent the place. So you can walk through, because you can never really tell on the phone. But to actually do that as a passive investor is really powerful. I mean, because you could call and check the rent prices and all that. And that's something I'd never even occurred to me. Like, oh, that's really good. You could do that. I love that. And then you're right. As a general partner, do they have the processes and systems and the methodology to fully analyze it? And I like the fact that you've got that buffer. And you said something really important. As one of my early mentors said, you need to look for the reasons why the deal won't work. And that's just what you said. And I think that's the best. You need to figure out why this deal doesn't work. If you can't find anything, and you need to genuinely look, if you can't find anything, and there's always going to be some issue with a property. Oh, there's no perfect property out there. There's always one element that, but you need to be aware of it and then mitigate those risks. But I really love the recap on both sides. So that's really good. You know what? You're somebody I think I'd probably passively invest with. Yeah.
I would love that.
I think so.
Yeah.
Okay. Let's
That,
move on to, was anything else you wanted to add there?
I want to add that, we talked about these two topics, but there are plenty of other elements that a passive investor should look at. I mean, of course, there's I talk about 3 Ps in a syndication, which is the people, the property, the plan. And each of these need to be really dug deep at a molecular level. Who's the team? Their background, the property, the markets. So that comp study we talked about, mystery shopping, was just part of that property. And of course, the plan. How is the value being created in this asset over the hold period?
So let's talk a little bit about your why. So why are you in large multifamily? Why do you do what you do? And that's important as a general partner, as a limited partner. You kind of got to know yourself to know what's good for you, what's a good fit for you. So what's your why?
Yeah, the answer is pretty deep, Matt.
Go,
And
do it.
don't do it.
Do it. Yes, do it. Yes.
Do it. So I go back. Why did I come to this country? I was the first one in my entire family to ever sit on an airplane. Why?
How old were you? How old were you?
I was 21.
Okay.
So why? Why do I have to go at a place where I don't know anybody? I don't have any financial backing. Why? So that's the ambition, right? So ambition, curiosity leads to ambition, and then ambition opens the doors of experiences. Experiences then makes you feel in a certain way where you find your why, right? I mean, that's the journey. It starts with curiosity, powered by ambition, takes you to experiences. I bumped into my wife now, we have kids now, we have 2 boys. So if you've asked me that question, 6.5 years ago, when I did not have a child, my answer was different. I was all about building the business. That was my first business that I was building back then, second in the works. And it was all about ambition, both me and my wife. Then kids came and perspective changed. So that's the experience, a new experience in life. So the why changed. So back 20 years ago, it was all about me. It was all about my ambition, my growth. Then it's about us, me and my wife. And now it's about a family. So the focus has totally changed in the last 2 decades. So today, when you ask me the question, what's my why? I want to work less and earn more so that I can spend time with my kids. It's as simple as that. It's that part of my life which dictates everything I do. And I'm not alone. I mean, there are millions of people are like me. People invest for the same reason, be it stock market, be it real estate, be it whatever, so that they can buy time. I always ask this question to my wife. What does money buy? Well, money buys things, cars and the houses. Then that's the lowest one. Then the money buys experiences. So that's like the level 2, but the top is money buys time. And then time gives you the freedom. And then freedom gives you experiences and the things, or whoever you want to do, whenever you want to do. So to answer your question, what's my wife right now? It's all about my kids. I work from home, and I love every single moment I spend with my boys. I have 2 boys.
Great. That's great.
That's it.
Wonderful. You've accomplished a lot at your age. I mean, you underplay. You've got a quite very successful tax business with 4 locations and all that, and then you're doing real estate on top of that, and then you're a wonderful dad, and then you take time to meet with me for 2 hours a week. We chat with our little super squad group with Vinky Lomba. So that's wonderful that you really do prioritize your world and your life, and I think that's wonderful. We could all learn a lot from you.
Well, you're too kind, Matt. I will say that every day, every moment, everybody is given a choice. Everybody is given a choice to how they spend their time. It's hard, of course. I mean, you have a very successful real estate business, and I know you go through the same choice. I have 1 hour to have lunch with my wife, my phone turned off, everything off, just you and your wife, or versus take this 1 hour and find more opportunities for your investors, right? So every day, every minute, every hour, you're making this choice. And if the why is always aligned, their priorities are aligned, no price is expensive to make the right choice. So what if business takes 5 years to grow instead of two? The Halloween or the fall, the pumpkin patch, what's the price on that? Doing that on a Thursday afternoon, what's the price on that? Or going to a zoo on a Monday morning, what's the price on that?
Exactly.
That's the why.
Fully agree. Some heavy, good stuff. Really good stuff. We're going to
Indeed.
lighten things up here. We're going to go into the rapid fire 5. This is just to get you to know you a little bit better. You ready?
Yes, should I be scared?
Be a little bit. No, you know the answer. You're the expert on you. You know all these answers.
All righty, let's do it.
Number 1, what was your nickname as a child?
Honey,
Honey?
honey, like Honey, honey. It still
That's-
is. There's a large chunk of population in India, my extended family. They don't know my official name, Kunal.
I mean, you're not just talking immediate family members. You mean like uncles, cousins. They call you Honey?
Honey, they call me Honey.
I
Yeah.
love it. You know, that's what I'm going to start calling you. You can expect my next text to you is going to start with honey. I love that. I love that. That's great. Okay, number 2. Are you a morning person or a night owl?
A night owl.
Okay, that's it. We're kindred spirits. You know that.
We those 1 a.m., 2 a.m. Pacific time, a text goes out to Kunal and Matt replies back within seconds.
I think it was last night. It was 3 in the morning. I was texting you, which was midnight your time. So yeah, you are a night owl. I know that for a fact. That's wonderful. Okay. What would be the first thing you do if you won the lottery?
How much?
Oh, let's say life changing, like 5 million.
$5 million. So after I pay my tax, it'll be close to.
Okay, let's say $10 million.
All right, you cannot ignore tax unless you invest in real estate. So 10 million lottery, 50% got in tax, 5 million in hand. Matt, I run a nonprofit. I think, and I at least 10% of everything I goes to the nonprofit. So 10% is right there. It goes to my nonprofit. Then, of course, real estate investing is a part of it. And then I'm going to have another big chunk go back to India and donate about $500,000 to a group of people that I had been, when I was there for 20 years, I never celebrated my birthday as a party. I used to take the money that I used to get, and I used to ask my grandma to cook rice and lentils, and I used to go to this slums by the river, about 20 minutes from my house where I grew up in a very small town, and I used to have lunch with them. So I still have I did that for 15 plus years that I remember. So I want to take that, I want to build some housing over there. And then, of course, my family and my kids.
That is wonderful. Yeah, I'm getting a little verklempt here. It's so sweet. Number 4, if you could live anywhere in the world, where would it be?
California. I love where I'm at.
Number
Go ahead.
5, what's the one piece of advice you would give to new investors to help them get better returns? The one golden nugget.
Passive investor?
Yes.
One golden nugget that I would give a passive investor who is just getting started is do not fear risks, but rather learn about them and learn how to mitigate them. There are always risks in every investment. As a passive investor, usually a passive investor step back from a great opportunity because the fear to lose the capital far exceeds the desire to win. So if they're able to mitigate those risks, either by communication or chatting or knowledge or reading a podcast, whatever that is, whatever avenue, that if you imagine it's a bar chart, right? It's like 10 on 10 on fear and probably 4 on 10 on desire to win, right? Knowledge will bring this bar chart down and the desire to win will far exceed. So
Excellent.
mitigate risk with knowledge, with podcasts, with network, so they feel comfortable making the decision to invest with a sponsor.
There you have it. Mic drop. I have nothing more to say. That's outstanding advice. That's some of the best advice I've heard. Finally, Kunal, how can people get a hold of you? How can they learn more about the wonderful things you're doing in real estate?
Yes, on my website or LinkedIn or Facebook. I'm very active on Facebook, relatively decently active on LinkedIn and on website. My website is libertycre.com. And I'm on LinkedIn, Kanul Dewan, on Facebook, Kanul Dewan. That's the best way to reach out to me.
And all that information will be in the show notes as well, because you'll want to reach out to this guy.
And if you go on my website, or if you can just DM me on LinkedIn or send me a private message on Facebook, I have a checklist for every passive investor. It's a very comprehensive checklist in the most simplistic layman terms. It's a series of questions they can answer. And there's even a flow chart. They can just follow the flow chart if this is a good investment for them or not. It's on my website, or send me a DM and I'll send you that checklist, the passive investor.
Outstanding. Educating, just like you said. That's what you're putting out there. Wonderful. Thanks again for being a guest on the show. I really appreciate it.
It's a pleasure, Matt. Always great chatting with you. I'm so glad to be here today and share my experiences and my mistakes with your audience.
Thanks so much. We'll talk soon. Bye-bye.
Bye.